Hi, everybody. Jeff Yastine here. Welcome to another edition of Wealthpress TV. Make sure to like and subscribe to us and follow us on social media, and also leave a comment or question or two in the comment section below. So I'm joined by Lance Ippolito. How you doing there?
Hey Jeff, great to be here.
One thing I know that's sort of near and dear to your heart, and figured we'd talk a little bit about it here, is, and this is true for a lot of people, myself included, is we're all always scouting for those companies that are the small companies that we think have the wherewithal to become big companies, whether it's in a handful of years or a number of years, just as progression as their businesses build. And I'm just curious if you want to sort of start things off and talk a little bit about where your interest. Obviously, it's money, right? It's making money and making money for your subscribers.
Right. So, one thing is I'm very fortunate. I've made a lot of money in the stock market, and now with the popularity in stocks, I start seeing more walks of life get in the market, whether you're fresh out of college or in college, or if you maybe worked that desk job for 10 years and you're just sick of it, you're bored, or if you're a fresh retiree, and you find the market interesting. I mean, it's something new every day. That when I go and talk with just normal folks out there, and they bring up, stock, because usually, you get that question, what do you think of this stock? Or what's a good stock to buy, right? If you're sitting at the bar and someone, recognizes you, just strike up a conversation. And I would say a very high percentage of the time, it's a stock that is already, the cat's out the bag. It's already heard about from not only the mainstream media, but the financial media, and it's already discovered, basically. And by that time, sadly, it's too late, right? When everybody knows about something, it's Wall Street has already made the move. They've already made that money, right? There's no free lunch in the financial markets. And even if you come from a very educated background and you think, oh, this is the next big thing, usually Wall Street's already 5 steps ahead of you. So instead of having that mindset of that reactive approach to trading and investing, what I like to do is try to implement the education of how can you be proactive? How can you find that next stock, that next investment, or that next trading opportunity? And then when everybody else hears about it, when it's the most popular darling out there, you sell it to them. And that's when you cash in and put that money in your profit. I try to be proactive in my trading and investing. And that's one big thing that, I try to not only tell my subscribers and just regular folks out there, but having that mindset of, being ahead of the curve, being proactive rather than reactive.
Yeah, no, I know what you mean. What's the first step for you? How do you find the companies, your favorite companies that you like? How do you find them?
So one major feature that I really like, and everyone can use it now, it's public information, is looking at like 13F filings. So you could go on websites, and I have no association with them. Just again, it's open, free out there, like whalewisdom.com. Or looking even at insider buying, like Open Insider or InsiderCow.com, those names. And what I like to do is look at these kind of undiscovered talents. I always feel like I'm like a scout or like a movie producer, and I'm doing auditions, and I'm trying to find the next Brad Pitt or Angelina Jolie, or I'm a football coach and I'm trying to find the next Tom Brady out there before, that $100 million price tag on them. So I like to see what they're buying, right? And what they're adding, what they're selling. And especially if they have a really good track record, these big investment funds out there. I'm not going and saying, oh, look, Warren Buffett's buying Bank of America. That's a great one. Not stuff like that. I'm trying to find that, that next disruptor of a stock or in an industry, and saying, oh, okay, let me investigate. And then I'll start going not only from an institutional filing perspective, but usually these companies are newer. So I'll look at the technicals And then instead of being so focused in on fundamentals, so to speak, and valuations, because they really don't matter anymore in this market, I'll start looking at management and what is management's background, and do they have not only a history of running successful companies, but are they really aggressive? Maybe they're buying stock. Maybe they're, that next generation of like Etsy CEO or Lululemon CEO. Do they kind of understand the future of where technology is going? I don't want like an oil or gas company where the CEO is a 75-year-old gentleman, who's already made his money. I want them to be hungry. And once I find that, and especially if the name has options, I'll start tracking institutional order flow in the options market and really just start seeing like, okay, are some more funds coming along for this ride? Maybe it was just a few, and then you look at next quarter's 13F filings, and okay, well, 5 more funds added, and really start building that momentum, that snowball effect, and really kind of just piggybacking. I'll let them do all the research because I'm not the smartest MBA PhD out there on as an analyst out there. So I'll let them do the hard work. And I think most folks, they don't want to spend hours doing research, and kind of piggyback off them, ride their waves.
When you move past the sort of, let's say, the early fundamental analysis, what you were just describing there, and then do you look at any technical analysis elements? Do you have particular sort of technical elements that you're looking for, or are you just buying strictly on the fundamental side of things?
No, technicals are important, and like you said, especially some of these newer companies, you'll have not only a lack of charts just from them either being public or choppy trading, but I really like to see volume picking up. So you can look at does volume exceed its 200-day volume average? You could go on a website like the NASDAQ.com and find that analysis. When the stock has a breakout, let's say it takes out its prior high, is volume picking up? And when the stock is trading sideways, consolidating, that's in my opinion, that's when I want to get in before the breakout. Is the stock holding support? What scares me, and I see this a lot with people, is they see a stock up like 10 to 15% in a day, and it's already made this surge. And then that's when they want to get in because they think, okay, now it's safe, now it's going up, and that's usually the time to sell. You really want to show these names love when nobody else loves them, and then when they do start gathering attention, or obviously the shares trading higher, volume picking up, just ride it until you're satisfied with your profits, or use that opportunity to start trimming some of the position there.
How long did it take you to kind of get that sense of like you're saying, show them love, show these stocks love when the rest of the market's running away? Because that is when you're getting, the best prices.
Right. Definitely. I always say buy on blood, right? Don't buy on big green days, buy on blood and have that confidence. Therefore, you're not going to get the perfect fill. You're not going to get the perfect entry. There's absolutely no way. If you think you're going to call the dead low, you're wrong. But what you can do is you can set whatever price you want to get out. So that's something that you can control, of where you exit, where you take profits. And that's a very important thing. So like you said, going in, starting to get into the position, knowing, let's say you buy a stock at $10 and it goes to $9, saying, okay, maybe I bought a quarter of a position there. So you pepper in, I'll buy another quarter of a position at $9. If it goes to $8, I'll buy another quarter of a position. And maybe it starts going between $8 to $10 to $12, and you start building a base, and every down day you start adding if you really like it. On something like that, it does take, I feel, confidence in the investor or trader doing it, but also, having that discipline to not chase something or not go all in at once. And I feel, especially for new investors, they just want to get in a stock because they think it's great. And then maybe the stock is offering or has a downgrade or has a bad earnings report, and then it just shocks them, and not only does it humble them, but they lose a lot of money, and that's scary. I know one stock, and we talked about this for briefly, just through text, was a ticker symbol JMIA, Jumia Technologies, the e-commerce name out of South Africa. So 2019, it looks like it went public or got back in April here, and it went. It looks to be from about 20 to 49 and change, and then traded around 25, and then went down to $2 a share, actually, which is crazy. But the story of that one back in July and August is the stock was trading, let's say, around $5-6 a share, building a base, and that's something that, to me, when it takes out that prior high, which was around $8, is interesting. And the history of this company is it's an e-commerce name, I believe, out of South Africa. Citron, a very popular short-selling firm out there, they had a negative note on it, calling it a fraud and other things. They've had good calls, they've had bad calls, so I'll give them props. And then, they've been humbled quite a few times as well. And so the stock has a high short interest, meaning a lot of people are betting against the company. Therefore, when the stock starts trading higher, those shorts have to cover. It can send prices higher drastically and quickly. So a name like that, it was a tech name that kind of got a second wave, especially a lot of these e-commerce names have done very well with the whole pandemic and such. So I remember that name when it was trading around like $10-12 or so. I started to get into a position, and I traded around it. I didn't sell it at $20 or anything like that. There's no way. But I remember when this stock was trading around that $18-20 level. So obviously a phenomenal run up, right? The stock doubled in price, more than doubled in price. I started seeing that mainstream investor and trader talk about it and go after it. And I'm pretty active on Twitter, and I would see, the Lion King with Simba, with the lion holding him up over the cliff, and say, Jumia, the next, the Amazon of Africa, this baby's going to 40 per share. And everything looked amazing about it, right? The technicals, just the stock was surging on demand, surging in volume, pardon me, and just it was moving up nearly every day. But that popularity between the normal investor and trader and starting to get so many eyes on it, that's scary. And when a stock has a lot of eyes and everyone's leaning on one side of the boat, which was bullish in this example, that's when they usually have the rug pulled after them. So again, a name making a comeback. I really shouldn't say a new name, but a new tech name. It starts getting that big mainstream crowd now, causing prices to go up. And right around earnings, it was actually a couple days before, because now expectations are high, and the stock's already up 100% to where it was just trading a few weeks ago. That rug got pulled, and that stock fell from around $18 to $12, I think, in a day or so, and then it continued to move lower, and volume just dried up. The stock actually got around $8 a share and started building a base, and that wipes out the average investor or trader, or that person who's buying long dated expensive options, because the volatility is expensive. It's definitely a high mover. That's what scares me. And when I talk to normal folks out there who say, man, I got burned in the stock market, that's a very common story. And then they have this like hatred, or they don't want to get involved in stocks, and they just have this bad taste in their mouth. And then next thing Jumia, just in the past couple weeks or so, the stock's doubled from $8 to
Yeah.
well, it's almost 16 a share, 15 and a half per share right now. And then they're left now thinking, all right, well, now's the time to get back in, after it made, nearly 100% move from where it was just trading. So really that not only psychology, but that understanding of sentiment out there, especially in a newer company or a company that you think may be the next big thing, always take that step back and put that ego aside, so to speak.
How long did it take you to sort of learn that side of investing or speculating, if you will?
Well, it actually happened, and I'm very grateful for it at a young age. I remember I was watching Jim Cramer, and he told me to buy, or he was doing, his buys and sells. And I remember one name was Yamamoto Gold, ticker symbol AUY.
Yes.
And I think at the time it was trading around like, maybe like 15, 20 bucks or so. So I remember I bought shares of it, and they had this whole segment of them like in Argentina and South Africa, like, with the gold and the CEO saying, oh yeah, revenues, this.
Right.
And, I put money into it, and within a few months, I was down 50%. And at this time I was young and losing a few grand. I was like, how did this happen?
Yes.
This was supposed to be the next big thing, so to speak. And I just got burned. And then ever since then, I started realizing like, I need to do my own independent research, but also not just following the crowd because it's too late. Another example of that recently is a name like DraftKings, and people think of sports betting and stuff like that. I mean, really, it's a technology company out there, but this name, just another big mover from, it was a VTI, was it VTIQ went public, no, that was Nicola.
Is that the South Korean record label? Is that the one I'm thinking of?
It might be, but was it? Yeah, DraftKings. There's so many of these SPACs too coming out now, especially with management, that I feel like they're just all trying to go public. But I remember watching this name around 60, in the low 60s a share. It was getting featured like every day on CNBC, and everyone was long. It had that pack mentality, and obviously no one can predict the future. But if you look at valuation wise and such, the stock's pulled back about 20 bucks in the past couple of weeks, and now people are like, they're hating on it, or they're thinking like, how did this happen? And really, the stock just pulled back to now entering some support, really. Right. But that same kind of chasing or getting in on the late stages, it causes a lot of pain, and that's why when we were talking, and even when I talked to normal investors and traders out there who don't do this full time or haven't been doing this for years, you really need to not only do your own research, but when you find these new, let's say, darlings of the market, or this new stock that's it's not an IBM or Oracle, really have that mindset of, okay, where do I want to get in, where I feel like I'm not chasing or I'm not getting in that momentum or that FOMO, and where's a good place that I should trim some of the position where I feel comfortable. And something like DraftKings, like, I'll be the first one to say, I had this stock around like 17 a share, and I sold it in, I think when it hit 30-ish or so. It was actually my first sweet spot stock that I put out. This was back, I think, like in May or something. And it continued going higher. I think it hit like 40, maybe even like 45 a share. And I was like, oh my goodness, I should have held it. So I kind of had that seller's remorse.
Right.
But at the same time, I'd rather have seller's remorse and have money in my pocket than, get that fear, let me buy and have my account going negative, so to speak.
Yeah, I know what you mean, because it seems like, and I think I keep repeating myself, as far as we're hitting these like key elements that so many of us have tripped up on at some point, when we first began investing. But that's another one that I think folks sort of, have to learn the hard way, is that you suffer if you bet too large, and the stock that or option that you went for winds up taking a bath. It's devastating, or can be devastating emotionally, and then that kills your confidence. And then the next time around, you'll have this completely great setup right in front of you, and you don't want to take the trade because it's like the person, when I was a kid, if I stuck my finger in an electrical socket, you don't want to do it a second time. And yet in this case, obviously, it's one of those deals where take the trade. So I know for me, the thing I learned the hard way is to trade smaller. And like you were saying, don't wait around so long. Take, even if it's only selling half a position, get that sort of positive reinforcement, because after you've been around for a while, you recognize like, oh, okay, I'm going through a bad spate here. Just keep it together and it'll be fine. Trade smaller, don't blow out your account, and keep going. I presume you probably had similar experiences.
Oh yeah, I've blown out a handful of accounts. Thankfully, they were small accounts getting started, only a few grand or so. But
right.
And those are lessons that I feel every trader needs to go through. People can say paper trade, and yes, that's good to get a feel, especially to learn a platform. But to have that emotion, I don't care if you have $1 million just sitting in the bank. Trade with 1% of it, right?
Yes.
And start getting that feel, because you're gonna have that emotional tie-up, or you're gonna find that next best stock, and it's gonna burn you. I'd rather lose $10,000 than lose $1 million, right? And learn that lesson in a smaller level, but still have that lesson learned. And I was just experiencing that with Fastly, ticker symbol FSLY. This was another name that I found in the 30s. I was
Fastly's they're like sorry, I didn't mean to cut you off. They're like a cloud platform company of some kind, correct?
Correct. And they were, I believe they had, I think it was 10 to 20% of their revenue coming from TikTok, which now obviously we see the whole TikTok situation play out.
Yes.
So this stock, it had nice institutional buying in it between the mid 30s to 40s, and it doubled. It was trading up to $80 a share. I think the last portion I got out was like in the 70s or so. And then the stock goes from 80 to 100. And I was like, goodness, like this is insane. This is a parabolic move. And yes, I caught some, but it's continuing to go. And now it started picking up popularity. I started noticing it more on social media, Twitter, stuff like that. And what happens too, as these stocks become more volatile, and as they start trading in very aggressive ranges, the volatility in the options, especially if you trade option, goes up drastically. So you're paying now for options very, very pricey. And this stock had a beautiful move, another leg up from like 80 to I think like 110 or so, and it was reporting earnings. And people, again, thought, this is it. This is the next, big thing. It's going to be a $150 stock. I got to get in. I got to get in. I got to get in. It had the rug pulled. It went from like 115, I believe it was, to about $80 like that. And we started having the TikTok scenario. A lot of these growth names started to pull back and such. And again, I was out of this name, but as this name's consolidating, I think traders and even investors have to have the mindset of, okay, when it consolidates, is this where I want to enter a position or get in? Or do I see this as a long-term play? Or am I just going to trade around it? And over the last run-up that we had in September on some growth stocks, it had another parabolic run. And from a fundamental perspective, it's like, why? TikTok, they lost, I think it was 10, 20% of their business from TikTok and such there. But it continued to move. And it had that FOMO effect where everyone's talking about it, everyone's getting in. But by this time, it was widely known. You know, it was on the ticker of CNBC. You know, my grandma knew about the stock, right? You know, the average Joe knew about the stock. So it wasn't that undiscovered talent. It wasn't that, you know, darling like it was at 40 a share or 60 a share, or heck, even 70 a share. And, you know, I saw the same thing. People going out buying leaps, buying these very expensive options, you know, paying $20 or so an option. So $2,000 for just a contract. And Name had earnings this week from 136 to, what is it now, 84 and a quarter a share. It's just, not only is it a painful lesson, yes, but it's that same kind of psychology and effect of growth stocks. And this has happened with Amazon around earnings and some of the biggest tech names now that are household names. You're going to have these cycles of, yes, they're going to come in, right? They're going to pull back, especially if, you know, let's say they're barely making money, if that. And then people get mad. They get that anger for it and such like that. And, you know, just another example, you know, in 3 months, will the stock be over 100 again? Possibly, especially if we have, you know, continuation in the growth stocks and in the NASDAQ. But right now, as a trader perspective, I don't want to touch something like this. You know, I don't want to touch a name like Net that made an incredible run, Cloudflare. I don't want to touch Jumia right now. I can put these names, and I think it's wise to put them on your watch list, or maybe even, you know, buy, let's say, a couple shares or so, whatever your account size is. Like, I like to buy on a stock that I follow, I'll buy 100 shares. Just so I see it on my portfolio.
Right.
And then
so it stays on your radar.
Exactly. And then add 100 shares. Oh, it's down, add 100 shares. And be like, okay, now do I really need to consider building a position into it or get serious about it? And I'll do that with like literally 20 to 30 stocks where I'll just buy 100 shares. And then a week later or a couple weeks later, reevaluate them and say, do I still like them? Or am I caught up in this FOMO effect because everyone's talking about it, that I just bought it, you know, because I wanted to right there without looking at the bigger picture.
Yeah, what you're describing, it's really, are you playing the longer view, or are you just getting caught up in the sort of roulette horse race mentality, right, that it's so easy to find yourself, especially when you're new, to get swept up into things. So Lance, it's probably a good spot to kind of wrap things up. Really appreciate you coming on. This half hour, 40 minutes, whatever it's been, goes by very, very fast. So thank you. I know everybody learned a lot.
Thank you, Jeff. It was a pleasure.
And for all of you watching at home, just make sure to like and subscribe to us, leave a comment or a question, and we will talk to you again next week.